This is the Tax Platform, informing the nation of tax matters. I'm your usual host, Dumelo Randau. Welcome to the Tax Platform. This week we look at the tax implications of bad debt write-offs. Now, there are instances where a business will write off a debt of a customer. This customer may not have been able to pay that debt. Some maybe for over 6 months, some for over 12 months. So, the Commissioner General allows taxpayers to claim these bad debts for income tax purposes as an expense. So, if you have written off 100,000, you're allowed that 100,000 as an expense. Basically, claiming that as expense reverses the initial leg of income. So it reduces your income in subsequent tax years, meaning you will then pay less tax. And generally, if you've issued a credit note, or if you have done some of the accounting adjustments that are generally acceptable, it will be considered as writing off that debt. Or if the debt has been there for more than 12 months, it will simply qualify as a bad debt for tax purposes, and you'll also be able to claim that. Now, apart from income tax, some clients or taxpayers may be registered for value-added tax, VAT. So where you have provided a service to a client and you billed them for that and you charge them VAT on that, that simply means you're going to pay VAT on their behalf. Because remember, for VAT, it's not dependent on whether you have paid by a client or you have not been paid. As long as if you issued an invoice, the VAT is due. So you would have paid that VAT and the clients would not have paid you. So when you write off that debt, then that means you can claim input tax on that debt, simply because that VAT you have not received it, but you have paid it. So you are claiming it back from best to say, look, I have served this client, now they have not paid me, so I'm claiming back the VAT that I paid you. And the issue of 12 months applies also when it comes to VAT and the issuance of a credit note. So it is important that you have documentation to prove that indeed you have followed up that debt and you have exhausted all the means available in trying to secure that debt or claim from such a client. And the credit note should be proof that indeed you have written off that debt, or whatever documentation that you may have internally as part of your business processes. It should suffice as proof that you have indeed written off that bad debt. Now, for both income tax and VAT, if at a later stage the debt that you have written off, the client pays you or you are able to recover, that means you also have to reverse now, and for income taxes, treat that as income, or for VAT, treat the VAT element as output tax, to simply show that no, I have finally received the amount that I had claimed I did not receive from that client, and I written off the bad debt. So in a case where you've written off the bad debt and you haven't received anything, it's just an incentive in recognizing that we had taxed you on those amounts. Now we are reversing that. And if ever there's a chance of recovery, not a chance of recovery per se, but if it is actually recovered, that's when now you'll also pay the tax. But if you have paid tax but you have not recovered, then you can be able to claim that tax back, or you can be able to reverse such income and claim that as expense. I hope that was insightful. Continue to listen to the Text platform. We are available across all your favorite podcast platforms and social media platforms: Facebook, YouTube, podcast platforms, Spotify, Apple Podcasts, Samsung Podcasts, Google Podcast, and all those other platforms. Have a good day. Thank you.